Absa Wealth provides investment management solutions to individuals who have in excess of 15 million rand in investable assets. With the affiliation with Barclays Wealth, the Absa Wealth focuses on global asset allocation and then personalises portfolios based on individual client needs. For more on the group's investment strategy, Philip Bradford, Chief Investment Officer at Absa Wealth. Well, that puts us out of the equation. We can't come and speak to you, can we? Now, Wayne terrified us before we came to the break. And
also excited you.
Well,
I said it was
but
both.
you
I
said
said it was both enticing and terrifying.
But then we debated a little, and you said that
Look, I think it'll be all right.
The market could be telling us something.
Yeah, but the market can be wrong.
So where we're going with this is that he told us that BHP, Anglo American, where they are trading at the moment, indicates that the market is anticipating something dramatic. Do you think the market's anticipating something dramatic?
Well, I think a lot of dramatic events are unfolding globally, and those are obviously impacting on the valuations of some of the local stocks. Listening to what Wayne said earlier, what is attractive obviously are the stocks like BHP, Sasol, Anglos and so forth, which are attractively valued. But as we know, their earnings are very much very volatile type earnings, and that is our concern. Those earnings could obviously fall away. So the South African market is in a difficult space right now, where you're more reliable defensive type stocks are not as not as well valued as your more risky type stocks. But on the global side, though, I think that's where I get a lot more excited when I look at the your global blue chip type stocks, your more dependable businesses, the names that all of us know, the Nestlés, the Chevrons, the BPs of the world, the Intels, those types of companies where we've got a lot more confidence of their earnings going forward, compared to like resources type companies. Those are the companies actually that are for once are looking very attractive.
And we're hearing this a lot at the moment.
Oh, no.
Many fund managers are saying that's the place to go.
There are shares overseas and markets overseas that are seriously cheap. Now, if you're a US investor, do you buy the share market and get a 3.5% dividend yield? Or do you buy the bond and get 1.55% dividend yield? Remember, the ones even taxed at half the rate of the other one. Now, there are seriously cheap shares overseas, but the problem is there's probably more bad news overseas, generally speaking, than in South Africa. So you got to, once again, look, shares are never cheap.
Does that mean, though, then the shares globally are going to get cheaper because of the bad news?
It could be, but they are valued. I mean, you should actually be buying them. But understand one thing, shares are never cheap when there's good news around there. Shares are only ever cheap when there's bad news around.
That's exactly right. And I think very seldom do we find a situation where good companies are also cheap as well. And that's really what we're seeing on the global side. You're seeing these global companies have got cash on balance sheet, they're profitable. If anything, your biggest risk is that they're too profitable, and are they going to be as profitable going forward? But from a global asset allocation perspective, if you're an investor and you're looking at the world, global bonds are extremely expensive, as we all know. We saw the UK treasuries at the lowest, they said, since 1703 yesterday. The US at the lowest. They've been the German bonds
at zero.
Yeah.
German bonds are at zero.
German
zero.
two-year rates at zero.
You get no yield.
In that environment, you've been encouraged as an investor to take risk. And if the dividend yields on good, solid companies where they've got cash on balance sheets are higher than the bond yields, then you know that money is going to continue to support those
that's
stocks.
Another theme, this dividend yield story, and that there are fund managers out there creating portfolios, and obviously have been for a long time, on divvies, pure dividend plays. Yeah. Perhaps that's what we should all be doing.
Well, I think you've got to be very careful about that. So first of all, you've got to look for stocks that have high dividend yields. But then you need to find stocks that are going to be able to grow that dividend yield going forward. So you can't just blindly buy high dividend yielding stocks.
Because it may not be sustainable.
They might pay away all the earnings and then they can't grow going forward. So you need to look for companies globally that are not only have high dividend yields, but are profitable, are likely to grow those earnings going forwards. Their dividend payout ratios mustn't be too high. And there are a number of those companies right now. I mean, we've been looking at what we call like a black chips type of index of stocks that are sort of the extension of blue chips, where we look for companies that are profitable, look for companies without too much debt as well, because that's the other concern you may have. And there's tons of those globally, and I mentioned some of the names earlier.
The black chips, that sounds very good.
Look, be wary of just looking at dividends when you're buying and selling shares, because dividends can only be sustained if profits are sustained. So dividends cannot deviate from profit over time. But you've got to hope that management
is savvy enough to only pay dividends if they can continue to grow their company.
I'll give you a good example. If you look at the earnings valuation between Anglo American and I've said this before, if you look at the earnings valuation between Anglo American and SAB, The earnings valuation has never been that different. Yet when you look at the dividend valuation, it's not that apparent that Anglo's is cheap and SAB is expensive, because Anglo's dividends are low, SAB's dividends are high. So when you do investments, you must look at 20 different things before you take a decision. Don't just take a decision on one element only.
And I suppose that follows suit with your thinking as well.
Yeah, I think importantly as well, you need to look at asset allocation first and foremost. You know, we're talking about stocks immediately, but your asset allocation and how much risk exposure you take is really going to drive your returns in the long run. The next step then is stock picking. But I think importantly at this point in time, for South Africans who have money offshore, they should be, instead of looking at, South Africans historically take money offshore for safety type of reasons. So instead of sitting in cash and instead of taking your safe money offshore, take rather some of your risk budget or some of your equity budget that you would normally be investing locally in a market that you could argue is fairly valued, and rather look at moving some of that offshore, and rather than for your lower risk type investments,
moving offshore into equity specifically.
Yeah. Correct. And what you tend to find as well is the currency impact comes out in the wash of the earnings over time. Because the other theme that we've been playing as well is like an Asian fusion type of basket, where we're looking at developed market equities that are attractively valued, that are actually growing into Asia. Because if you chase the emerging market growth, you tend to overpay for the assets.
Give me a couple of examples. SAB would be one of the
SAB is
companies.
not necessarily cheaper. Not at a 23 PE.
But it's still got,
it's got that exposure
to emerging markets, unlike any other.
Yeah, Richemont's another one, exactly that. So instead of actually trying to move into those markets directly and overpay for stocks where they are overvalued, they are undervalued in Europe.
Nestle, 40% of Nestle's profits come from
and
offshore.
There's lots, I mean, basically all the big...
not offshore, emerging markets. What am I
basically all the big multinationals have got big exposure in China, because that's the growth area. I mean, that's this. But Philip's quite right. The problem is, you try and persuade an investor to go and buy a European share now when they look at the newspaper and watch TV every night. They're not keen, you know. So it's easy to sell something that's going up. It's not easy to sell something that's going down, even though people should be buying it because it's cheap. That's why you got to try and be you really have got to try and be unemotional about making investment decisions.
One of the things
easy to say,
it's
not
easy to say, yeah.
act on.
And very importantly, what we look to do for clients as well, because as you very correctly say, Wayne, very few people buy into asset allocation and just buying equity for the long run. They don't sit through the tough times. So we look to actually bring some different kinds of strategies into clients' portfolios where we may buy some insurance. How do we get a client out of cash locally, where they're now making negative real returns, into decent market-related type investments? And very often, sometimes you've just got to put some sort of insurance layer in place so that clients can sleep at night.
How are your clients responding to the developed world story? Are they being encouraged? Do they feel safe enough to go into territories like Europe?
Well, they obviously don't feel safe. I mean, there's no doubt about it that you don't want to be sending your money, throwing good money after bad money that you've already got invested offshore. But I definitely find that if you do put structures in place, like I mentioned, insurance type structures in place so that clients can feel comfortable, they're very much keen
So the
to take
downside
the
is limited. You
Correct.
basically cap the downside, so to speak.
Correct. So it basically plays on the behavioral weaknesses that we have as investors, and gives us the confidence to invest into the difficult parts of the world where we know that the most attractive investments are.